Welcome back. Markets are lower this morning. Take a look at futures indicating a decline at the start of trading in the triple digits on the Dow. The Dow is down 117, the Nasdaq down 52, and the S&P lower by 15 after the release of the Federal Reserve's financial stability report yesterday. This is the first report since the collapse of several regional banks back in March, the Fed warning that there is credit tightening concerns and financial stress. Take a look at the regional banks this morning. And we are looking at another day of weakness in the pre-market. Pac West down another 13% this morning. TD Cowen this morning out with a note saying that the smaller banks are the ones that have much of the exposure to commercial real estate. They say our view is that commercial real estate credit concerns may become the next focus for the banks as they seek to escape the bank crisis that we're looking at. Joining me right now to talk more about that is TJM Institutional Services Director, James Iurio. James, it's great to see you. Thanks very much for being here this morning. What did you take away from the Federal Reserve's stability report yesterday? Banks, apparently, according to Cowen, hold $2.17 trillion of the $3.57 trillion in non-farm, non-residential commercial real estate loans. Do you think this is going to be an issue for markets?
Well, yes, I think, of course, it's going to be an issue. But here's and that senior loan officer survey, too. It also said right now the percentage of banks that are increasing credit is the highest it's been even since the great financial crisis. So it's a big deal. But here's the thing that surprised me is that the Fed sets out to have credit be tightened, to slow down the economy, to break up demand. Why should we be surprised when that's happening? I hate when people always say it's a feature, not a bug, but it really is a feature, not a bug. This is part of the plan to break up demand to kill the inflation. Now, the markets don't like it because we are now moving from inflation to the recession, which we've been saying is coming for 6 months, and I know it's been slow in coming. But the part that's the most scary is the in-between where we have both, and that's where we are now. But the problem in the small banks, of course, that's we've seen 4 cockroaches. That doesn't mean that that's the limit of it. We know this too well.
Yeah, the small banks, defined as having less than $100 billion in assets, are the most exposed. They hold $1.55 trillion of those loans, non-farm, non-residential CRE, commercial real estate. We've also got data this week that we're focused on. We've got the Consumer Price Index out tomorrow morning for April, and, of course, the PPI out on Thursday. What are your expectations for the economic data, and how will that impact yields and markets?
So I believe that inflation is coming down, and it's coming down fast. I believe that this is something the Fed has already defeated. Unfortunately, the CPI can be a little bit backward looking. So I think the CPI, remember the last CPI we saw reflected crude oil prices trading in the 60s for most of March. This one's going to reflect crude oil trading above 74 for most of April. You couple that in with the fact that it's still counting in as the rents equivalence is coming down. It's still somewhat backward looking that. So I think this is the one scary CPI to me, more than most of the others. I think it comes in relatively high, and I think the markets suffer a little bit. Now, the stock market thing in this transition I talked about a second ago, it's a big deal. I don't think the stock market recovers, and I'm not interested in buying it until the S&P can settle, let's call it above 4250 for a day or maybe a week. Otherwise, I think it's a tough transition.
All right. Let me bring in John Lonski, who's with me this morning. Go ahead, John.
Yeah, I think when we're talking about credit quality, I find it surprising that despite these recessionary warnings that are being supplied by the Fed's survey of senior bank lending officers, we now have credit tightening and the interest rates being charged on business loans. They're at levels that are always associated with recessions. We still find the equity markets doing quite well. We also note that junk bond yield spreads, or the additional yield that investors demand if they're going to buy junk bonds, is very much well under what is ordinarily associated with a recession. So what I'm seeing right now is the market has yet to price in forthcoming credit problems, and that is one more reason to approach the equity market with the utmost caution.
Yeah, I agree completely. But I'll say to this is that when you throw $7 trillion additional dollars into the system in such a short period of time, great, M2 money supply has come up 4%, the fastest it has in history. But it's still, there's a lot of money sloshing out there that is still the wallpaper that's covering up some of these holes in the wall. And as we pull it back, we're going to find it. But it takes a long time to pull back that kind of money. I expected this to happen 6 months ago and didn't, and now it seems to be accelerating.
Yeah, James, real quick, do you think markets react later today to this meeting at the White House with congressional leaders on the debt ceiling?
I do, and I think right now the market's in somewhat of a bad mood because it's buttoned up against resistance, and I think it probably reacts to it poorly. I mean, it's going to be so much theater as we've seen so often. They probably get us right to the brink, and then they'll save us like they always do. And I think the market knows that, but I think the market has to be cautious and probably trades poorly.